Hello everyone, this is Dr. Leela. In this video, I am going to discuss on risk. Please like, share and subscribe. Risk. Risk refers to an evaluation of the chances that a future event may occur. Risk is assessed differently by different personalities. And when we talk about the organization point of view, you can define risk based on the factors influencing, that is, both internal factors as well as the external factors. The perception of risk varies from organization to organization. The definition given by Warren Buffett for risk is risk comes from not knowing what you're doing. And according to ISO, that is International Organization for Standard, risk is defined as combination of the probability of an event and its consequences. Risk. Risk, it is the probability of incurring loss or injury or harm. In risk, possible outcomes are known and they are tangible and quantified. In general, you can define risk as degree of uncertainty and the potential of financial losses that can happen due to an investment decision. The vital factors that contribute to risk are price and interest. All investment are risky, whether it is in stock market or capital market or banking sector or financial sector or real estate or bullion market. Risk arises when there is a difference between expected and actual performance, and the degree of risk is more when greater is the variation between the estimated returns and the actual returns. The degree of risk, it varies on the basis of the futures of assets, investment instruments, mode of investment, issue of security, etc. Therefore, risk is the uncertainties resulting in adverse outcome. Then, what is meant by uncertainty? Uncertainty means outcome probabilities are either unknown or estimated with low precision. That is, uncertainties can be favorable or unfavorable. Favorable, it is also called as certain when you can predict exact outcome, whereas unfavorable means uncertainty where you cannot predict the impact of the risk. Risk is influenced both by external factors, factors, and external factors. These are the factors that are uncontrollable and it broadly affect the investment, whereas internal factors, it affects a particular industry. Sources of risk. Risk is associated with the variability of future returns of a project, and the factors that influencing the future returns are size of the investment, life of the project, economic conditions, competition risk, industry factors, company factors, technology risk, market risk, and productivity risk. Let us see in detail the different elements of sources of risk. The first one is size of the investment. Size of the investment, here I am talking about in terms of the amount required, and this size of investment will determine the risk. Large scale projects are more risky than the small scale projects, that is, larger the investment, the degree of uncertainty is more when we compare with the smaller project investment. And the second one is life of the project. Life of the project, this also determines the risk. Longer the life, the risk is more. Shorter the life, the risk is less. And the third one is economic conditions. Economic conditions means these are the certain conditions which will influence the general level of the business activity. Here, economic conditions, it is referred to as risk exposure of an investment due to changes in the business conditions or adverse effect of external factors. For example, like government policies, political situation, monetary policy, fiscal policy, etc. This and all you can take it as examples under economic conditions. And the next one is competition risk. Competition risk means this is the risk which is associated when you are competing with the competitors in the market, because everyone, they seek to obtain the highest position in order to gain maximum benefits. And the reasons for competitive risk are level of efficiency, relatively with competitors, or changes in the customer taste and preferences, or lack of company's management, etc. And the next one is industry factors. Industry factor, this is the external factor which affects all the companies of the industry in the similar way. For example, like industrial relation in the industry, innovation, material cost, etc. This and all you can take it as example under industry factors. Industry factors, it is always macro in nature. The next one is company factors. Company factors, these are the internal factors which affects a particular company. Example like change in management, strike or lockdown or fire accident, etc. This and all you can take it as example under company factors. And company factors, it is always micro in nature. And the next one is technology risk. Technology risk means technology failure which disrupts a business. For example, information security incidents or password thefts or cyber attacks, etc. And next is market risk. Market risk, it is associated with the consistent fluctuations seen in the trading price of any particular shares or security. This market risk, it arises due to rise or fall in the trading prices of listed shares or securities in the stock market, or it is the risk due to unexpected changes in the macroeconomic factors like GDP, interest rate, inflation, etc. And the next one and the last one is productivity risk. Here, productivity risk means this is the risk which leads to loss of productivity. This loss of productivity can be due to weak performance management or low relationship between manager or employees, or inadequate technology, or suspicion about failure or lack of communication, etc. Different approaches to manage risk. The different approaches to manage risk are risk avoidance, loss control, diversification, risk transfer, risk retention, and risk sharing. The first one is risk avoidance. Risk avoidance is one of the way to manage risk. It deals with eliminating risks that possess a potential loss, or it means control strategy that attempts to prevent attacks, and this would result in least incentive. Next one is loss control. Loss control means it is to reduce the possibility of quantum of losses. It is designed to reduce both frequency and severity of the losses by changing the characteristics of the exposure so that it is more acceptable to the firm. Loss control has two sub elements. The first one is loss prevention and the second one is loss reduction. Loss prevention means to reduce the number of frequencies of losses, and loss reduction is to reduce severity of losses. For example, in order to explain loss control, here to manage the liquidity risk, firm may decide to always keep a certain portion in highly liquid assets. And the third one is diversification. Diversification, it can reduce the risk depending upon an investor risk tolerance. The concept of diversification means spreading your risk into different asset categories like stock, bonds, cash, and real estate. The reason to diversify is not all the investment perform well at the same time. Different types of investments are affected differently by different events and changes in the economic factors. The economic factors like interest rates, exchange rates, and inflation rates. The fourth one is risk transfer. Risk transfer means it is a technique where one party assuming the liabilities of another party. Under this, you can take all insurance products as the example. The next one is risk retention. Here, retention means retention in the decision to bear financial risk, thus increasing the uncertainty and variability. Retention can be in the form of planned retention or unplanned retention or funded retention or unfunded retention. Planned retention means here risk is recognized and absence of alternatives also forces the organization to adapt planned retention, whereas unplanned risk is not recognized. And when organization gets funds in advance to pay for losses, it is called as funded retention. Unfunded retention means when losses are paid out of cash flow or from funds obtained from the borrowings. And the last one is risk sharing. When part of the risk is retained and other part is transferred out, it is called as risk sharing. Therefore, managerial perspective of risk, it is classified into that need to be avoided, that should be transferred, and that should be actively managed. Causes of risk. The causes of risk are wrong decision, wrong timing, nature of instrument, credit worthiness of the issuer, maturity period, amount of investment, method of investment, terms of lending, nature of industry, national and international factors. Let us see in detail. Wrong decision to investment and wrong timing of investment is one of the major causes of risk. Next one is nature of instrument. Nature of instrument means here based on the nature of instrument, risk varies. For example, when you take bonds and bank deposits, they have less amount of risk when you compare with the shares. Credit worthiness of the issuer. Risk depends upon the credit worthiness of the issuer. For example, garment and semi-garment are more credit worthy than the corporate sector. The next one is maturity period. Maturity period, this you can call it as term of investment or length of the investment. This means long-term investment are more risky than the short-term investment as future is uncertain. The next one is amount of investment. Amount of investment, you can call it as level of investment. Higher the quantum of investment, higher is the risk. Next is method of investment. Method of investment means if the method of investment is secured by collateral, then the risk is less. If it is not secured with the collateral, then the risk is very high. Next one is terms of lending. Terms of lending, this talks about the length of the time it is possible credit risk. More the credit period, more the risk, which results in an interruption of the cash flows. Nature of industry. Nature of industry means risk is higher in speculative and cyclical industry, whereas for defensive and growth industries, risk is less. And the last one is national and international factors. International risk arises when earnings and cash flows is affected due to the unexpected exchange rate risk. When it comes to the national factors, political and legal factors, this arises due to changes in the government policies and certain legislative regulations. A stable government in the economy risk is less when we compare with the unstable government. Thank you.